Welcome back to The Explainer. Today, we're diving into what is probably the single biggest headache for most retail traders out there, daily bias. We're going to break down the exact framework that takes daily bias from a super stressful guessing game and turns it into a repeatable, high-probability institutional strategy. So, if you've been struggling to figure out the market's true direction, well, you're definitely in the right place.
Let's just start with a slightly harsh truth, okay? Ask yourself right now, can you state today's bias in one sentence? If you can't answer that instantly, in one simple sentence, right before you enter a trade, you don't actually have a bias. What you have is hope. You're basically outsourcing your responsibility to luck, just crossing your fingers and praying the price goes your way. And let me tell you, in the financial markets, hope is absolutely not a strategy.
So let's clarify what we're actually talking about here. Daily bias is essentially a high-probability plan of where price is most likely to move in the next 24 hours, paired with the strict invalidation point. And notice how I said most likely, right? Not certainly. Pro traders don't try to predict the future like fortune tellers. They totally accept uncertainty. They just use their bias to put the odds in their favor, filter out the bad setups, and, actually manage their risk.
Okay, let's dive into this. Here's our roadmap for today. First, the higher time frame foundation. Second, premium versus discount. Third, liquidity and traps. Fourth, narrative and targets. And finally, invalidation. Let's get right to it.
Step 1. The higher time frame, or HTF, foundation.
The absolute biggest mistake beginners make is dropping straight into a 5-minute chart. They just get completely chopped up in all that random noise and volatility. To find your true bias, you have to follow a top-down approach based on time and price theory. Start macro. Look at the daily or weekly chart to get a feel for that broader institutional trend. Then, you drop down to the 4-hour chart to map out your current swing range. What you're looking for here is your most recent strong high and strong low. This is crucial because it locks your focus strictly on what price is doing right now. Only after you've nailed down that broader direction should you even think about dropping to a 15-minute chart for setups. If you don't know where the higher time frame is heading, you're just flying blind.
Moving on to Step 2. Supply, demand, and zones. So to figure out who is actually in control of the market, buyers or sellers, we use the Fibonacci retracement tool. This helps us map out the premium and discount zones within our swing range. Just drag the tool from the swing low to the swing high. That 50% mark, that's your equilibrium. Anything above 50% is the premium zone. Price is expensive up here, so we're only looking for shorts. And anything below 50% is the discount zone. Price is cheap, so we only look for longs. If price mitigates a demand zone down in the discount area and pushes up, buyers are in control. If it hits a supply zone up in the premium area and rejects downward, well, sellers are running the show. I love this quote because it hits the nail right on the head. It's just like when you go to the supermarket. You want to buy when price is at a discount. You don't buy stuff when it's expensive. It literally is that simple. When price is just hanging out in the middle of your range, that equilibrium chop, that's pure indecision. That middle zone is exactly where amateur traders end up donating their money to the market. We, on the other hand, stay patient. We wait for the price to reach those extreme zones before we even think about executing.
All right, Step 3. Liquidity pools and traps.
Listen, price does not just wander around randomly. It is systematically engineered by algorithms to hunt for liquidity. Smart money, the massive banks and institutions, they need fuel to push the market where they want it to go. And guess where that fuel comes from? Retail stop losses. So you got to ask, where is this liquidity resting? Look for the most obvious magnets on your chart. I'm talking about the prior day high and prior day low. These spots are massive stop loss graveyards. You also want to mark out equal highs and equal lows. Breakout traders absolutely love placing their orders around these levels, which makes them the perfect targets for those algorithmic sweeps. Price will naturally just gravitate right toward these pools.
To really grasp how these sweeps happen, we use the classic AMD trap model. That stands for accumulation, manipulation, and distribution. Usually, during the Asian session, the market just accumulates and builds up that liquidity. Then, London opens and manipulates the price. It creates this trap, sweeping the liquidity and tricking breakout traders into going the completely wrong way. Finally, the New York session steps in and distributes the real explosive move in the actual intended direction. Just keep in mind, every true bullish move usually starts out looking like a bearish trap to induce sellers, and vice versa.
Step 4. Building the narrative and targets. Okay, so now we have our levels and our liquidity mapped out, but we need to tie all these pieces together into a cohesive market story. You need to ask yourself, Are we in a pro-trend continuation phase, meaning we're moving with the higher time frame, or are we in a counter-trend, short-term pullback phase? The golden rule here is to always trade with the internal order flow. And a huge warning for beginners, please do not try to trade counter to both the lower and the higher time frames at the same time. Trying to buy in a bearish lower time frame trend while the macro time frame is also bearish, that is literally just catching a falling knife.
A huge part of building this narrative is spotting fair value gaps, or FGVs. Honestly, when you open a chart, finding FGVs should be the very first thing your eyes jump to. These are massive imbalances where institutional buying or selling was so aggressive, they actually left unfilled orders behind. It shows up as a gap between the wicks of 3 consecutive candles. The market absolutely hates inefficiency, so price will almost always return to patch these leftover gaps up, giving us a fantastic, logical target or entry zone.
Once your narrative is locked in, you have to pick your target. And I am going to be super strict with you here. Pick one target. Remember, you are trading a specific location, not just a general direction. Pick a single, logical opposing zone, an unfilled imbalance, or a very clear liquidity pool for your take profit. Trying to juggle 10 different targets is basically a surefire way to induce mid-trade panic and totally mismanage your position. Just keep it simple, one direction, one target.
And that brings us to our final phase, Step 5, Invalidation and Avoiding Mistakes.
This right here is arguably the most crucial step, the one that separates the real professionals from the gamblers. Before you even think about entering a trade, you have to finish this exact sentence out loud. My bias is wrong if price breaks and holds a specific key level. And it can't just be a quick wick. It has to be a clear break and acceptance. If your invalidation level gets hit, you have to just accept the loss. You are wrong. Reset your bias, reevaluate the market, and absolutely never, ever revenge trade just to try and force your will onto the charts.
To keep that kind of discipline, you have to steer clear of a few major consistency-killing mistakes. First off, trading on feelings. Emotions are not a framework, guys. Stick to the checklist. Second, trading that mid-range chop we talked about earlier. Just wait for the extremes. Third, flipping your bias every single time you see a big 15-minute candle. Your bias only changes when your invalidation point gets hit, not before. And finally, trying to trade straight through high-impact red folder news events. If CPI drops at 8:30 a.m., you sit on your hands until 8:31. Don't mess with that unpredictable volatility.
So I've got a challenge for you. For the next 30 days, I want you to commit to this exact 5-step daily bias checklist. Map out that higher time frame, find your premium or discount zones, spot the liquidity traps, build a solid narrative with exactly one target, and define your strict invalidation point. But most importantly, journal the outcome of every single trade. I promise you, you're going to learn more about your edge in these next 30 days than you would in years of aimless chart watching.
I'll leave you with this thought to chew on. If you don't trust your own bias, how can you ever expect to trust your execution? Competence breeds confidence, right? And confidence breeds conviction. Put in the work, gather your data, and master this framework completely before you place your next